Semiconductors are ripping through a fearful market as structural hardware gains trigger a sector-wide squeeze. Micron is up 15% on 1-beta EUV efficiency. Intel climbs 14% on dual-pillar support, and AMD surges 11%. By Micron, lab score 71 out of 100. 1-beta EUV process yields 30% higher HBM2E stack density, directly feeding NVDA a 100's 1.6 terabytes per second memory bandwidth. This isn't about DRAM cycles. It's about winning in AI-grade memory, where Micron now holds 40% of supply. The die shrink isn't just efficient. It's enabling a new tier of accelerator performance. Micron's dominance in HBM3E power efficiency, delivering a 30% reduction in energy consumption per bit, is the primary driver of its $842 billion market cap valuation. While the market focuses on general AI demand, the lab is tracking the 1.2 terabytes per second, the measure of how much data moves between memory and the processor bandwidth ceiling of their latest stacks. Micron is utilizing its 1-beta node, the manufacturing process that uses deep ultraviolet lithography to create circuit patterns without the immediate cost of EUV, to outpace SK hynix on thermal performance. By keeping TDP, thermal design power, the maximum heat a component is designed to dissipate, lower than competitors, Micron allows NVIDIA's Blackwell chips to run at peak clock speeds without throttling. The engineering reality is that HBM3E yield rates, the percentage of functional chips harvested from a single silicon wafer, are currently the tightest bottleneck in the AI supply chain. While SK hynix pioneered the HBM, high-bandwidth memory, vertically stacked DRAM chips connected by TSVs, Micron's 12 high stacks are winning on vertical density. This reduces the physical footprint on the CoWES, chip-on-wafer-on-substrate, the packaging technology that bonds memory to the logic die interposer. With EPS hitting $16.68 in the latest quarter, the hardware reality justifies the 15.49% surge to $746.81. We are seeing institutional conviction because Micron solved the heat-to-bandwidth ratio that was capping total system throughput. Today's move signals that the market finally recognizes Micron as the structural gatekeeper of AI performance. Quarterly financials showing modest revenue momentum for MU. Micron's 15.5% surge today is a high beta, a measure of a stock's volatility relative to the market, sprint toward a valuation ceiling created by a 3.64% Fed rate that is now locked in place. While revenue exploded by 196.3%, the macro environment is shifting from a tailwind to a wall of friction. The yield curve, the spread between short and long-term interest rates, is finally normalizing, but this isn't a signal of easy money. With April adding 115,000 jobs, the labor market is too stable for the Fed to blink. Markets now price a negligible 6% probability of a rate cut by August. For a company with a 756% EPS, earnings per share, the portion of a company's profit allocated to each outstanding share, growth rate, the cost of capital is becoming a secondary concern to the inflationary pressure of new trade protectionism. The Greenland trade rhetoric and shifts in EAR Group D. 5. The specific federal export control classification for countries of national security concern signify a transition to total supply chain isolation. This isn't just about chips. It's about the raw materials and logistics that sustain Micron's global footprint. As the administration reignites trade war fears, the 7.3% recession risk calculated by the 10Y 3M yield spread is a shadow over these gains. While AI demand remains the hero of the narrative, tariff-induced CPI, Consumer Price Index, a measure of the average change in prices paid by consumers, risk is forcing a hawkish pivot. This creates a hard cap on valuation multiples for capital-intensive hardware. Micron is thriving in a vacuum of demand, but it is doing so while the geopolitical floor is being pulled out from underneath the entire semiconductor sector. MU reported earnings per share of $12.20, beating the Wall Street estimate of $9.58 by 27.3%. a solid beat that signals strong execution. MU is trending higher, currently at $746.81. Micron's management is spinning a flawless story. AI-driven memory demand, HBM3E, high-bandwidth memory, the stacked DRAM that feeds AI accelerators, supply chain resilience, and record shareholder returns. Every earnings call slide shows revenue growth accelerating, gross margins expanding, and capex discipline. The press releases gush about AI demand and supply chain optionality. Wall Street hears tailwinds. Flip the table. Insiders net sold 118,415 shares in the past 90 days. That's not a routine sell to cover. That's a pattern that historically precedes a margin inflection or a product transition stall. Executives see the order book today. If they're selling now, they're signaling the peak is already priced in. Micron just crushed EPS by plus 27.3%, a beat so large it looks engineered. But R&D spend grew only plus 10.7% YOY, slower than revenue. That's a red flag. When R&D lags revenue, it signals management is pivoting from product pipeline conviction to margin language. They're papering over a pipeline gap with share buybacks and PR spin. What management is saying, AI demand is structural. What the lab hears, we're out of HBM3E roadmap after 2027. A 10Q risk factors section would flag exactly that, product cycle risk and capex payback uncertainty. The glossy supply chain optionality phrase is code for geopolitical exposure. They're 1ER Group D, 5 shift away from margin compression. The PR is gloss. The silicon reality is a cliff. The momentum breakdown for MU. RSI sits at 88, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Micron's 1-beta, the proprietary process node that utilizes EUV or extreme ultraviolet lithography to shrink transistor dimensions, is finally delivering the density needed for HBM2E, high-bandwidth memory used in AI accelerators like the NVIDIA A100. With a forward P/E of 7.3x, price-to-earnings ratio based on next year's projected profits, the market is betting on a massive DDR5 server refresh. But here's what breaks the bull thesis. An RSI of 88.0, relative strength index, a momentum indicator where anything over 70 is considered overbought, signals this move is exhausted. While the cup and handle pattern looks clean, export controls on GDDR6X, the specialized memory used in high-end graphics cards, to China and looming DRAM oversupply from Samsung threaten to collapse those forward margins. The question management won't answer, can 1-beta yields offset the tariff hit on Taiwanese-made DRAM, dynamic random access memory that stores data in capacitors? The lab's answer is no. While the CHIPS Act, federal legislation providing subsidies for domestic semiconductor manufacturing, provides a long-term floor, it doesn't solve the immediate friction of ER Group D. Intel Corporation earns a 58 out of 100 lab score, placing the stock in a firm hold position. While the market reacts to a massive breakout, the momentum is currently anchored by the $8.5 billion Intel's move to $124.92 is a validation of the 18A process node, the 1.8 nanometer class manufacturing technology that represents Intel's leapfrog over TSMC's N2 timeline. While the market focuses on the Apple contract, the engineering reality is the success of PowerVia, backside power delivery that moves power routing to the rear of the wafer to eliminate interconnect congestion. By separating the power delivery from the signal wires, Intel reduces the IR drop, the voltage loss that occurs as current travels through thin metal layers, by nearly 30%. This allows for higher clock speeds at lower TDP, thermal design power, or the maximum heat a chip is designed to dissipate. Apple's commitment proves that Intel has solved the yield issues on Ribbon FET. Intel's implementation of Gate-All-Around (GAA) transistors that provide superior electrostatic control. Intel is now the first foundry to successfully integrate backside power at scale, a feat TSMC won't match until their INTC node, the performance-enhanced version of their 2-nanometer process scheduled for late 2026. This technical lead directly addresses the density bottleneck in modern SoC system-on-a-chip designs that integrate CPU, GPU, and memory controllers on one die. By utilizing 18A, Apple can shrink the die size while increasing the transistor count beyond what is possible on TSMC's current N3E, the refined 3-nanometer node currently used for high-end mobile chips. Today's 13.96% price surge reflects a massive reduction in defect density, the number of fatal flaws per square centimeter of silicon, which suggests Intel's manufacturing is finally stable. This engineering breakthrough transforms Intel from a struggling IDM, integrated device manufacturer that both designs and builds chips, into a viable alternative to the TSMC monopoly. Quarterly financials showing modest revenue momentum for Intel. Intel is the $146 billion geopolitical insurance policy for American big tech, weaponizing the CHIPS Act to offset a hawkish Fed that has crushed the probability of an August rate cut to just 6%. The Fed rate at 3.64% and a normalizing yield curve, the narrowing gap between long and short-term interest rates, create a brutal cost of capital environment for Intel's massive fabrication build-outs. With CPI, the Consumer Price Index measuring inflation, at 0.6%, the Fed is pivoting toward a hawkish stance that threatens high-growth multiples. This higher for longer reality forces Intel to rely on state-sponsored capital rather than cheap debt to fund its turnaround. The Greenland trade rhetoric and ER Group D. 5 shifts. The tightening of export controls for national security are transforming surgical sanctions into broad-spectrum decoupling. As tariffs threaten to spike the cost of imported silicon, Intel's revenue growth of 7.2% is being revalued as a domestic safe haven. The global tech war has moved beyond software into the physical choke point of sub-5nm production. While the broader market stumbles over renewed trade war fears, Apple's deal with Intel proves that the supply chain is retreating behind national borders. This is not a standard partnership. It is a defensive maneuver against regional conflict risks that could decapitate Asian logic chip supply. Labor data showing only 115,000 jobs added in April signals a cooling economy. Yet Intel's beta, a measure of a stock's volatility relative to the S&P 500, of 2.19 reflects a high-stakes gamble on industrial policy. We are witnessing the death of globalism as the U.S. government mandates a domestic silicon rebirth. The lab views this 14% surge as the market finally pricing in the sovereign silicon premium. Intel is the only bridge across the widening trade war chasm. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%. A solid beat that signals strong execution. Intel is trending higher, currently at $124.92. Segment 3. The PR Insider Filter. Intel Corporation. Apple just handed Intel a golden press release. Apple reaches chip-making deal with Intel, and the stock surged to a new record. Management is leaning hard on supply chain optionality and AI-driven demand, framing this as a long-term growth catalyst. But let's flip the script. Insiders net sold 40,256 shares in the last 90 days. That's not a trickle, that's a fire hose. When executives dump stock at these levels, it's not about confidence, it's about risk management. Historically, this pattern precedes margin compression or a product transition stall. Wall Street cheers the Apple deal, but the insiders are voting with their feet. EPS beat by a staggering plus 1971.4% last quarter, 29 cents actual versus 1 cent estimated. A headline win, right? Dig deeper. R&D spend cratered 16.8% YOY, now at 26.1% of revenue. That's not efficiency, that's a pipeline on life support. Management is suddenly obsessed with non-GAAP measures. In their earnings call, corporate speak for will tell you what to focus on. What they're not saying. The 10Q would flag capex overruns, node transition delays, and AI workloads still favoring NVIDIA's Blackwell over Intel's Foundry roadmap. The lab hears this. Intel is selling a narrative of revival, but the signals scream caution. The Apple deal buys time, not dominance. The real story isn't the press release. It's the silence around R&D cuts and insider sales. That's the gap Wall Street is missing. The momentum breakdown for Intel. RSI sits at 88, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. The lab sees two pillars propping up this massive breakout. First, the Meteor Lake launch represents a critical pivot toward efficiency via Intel's first use of EUV, extreme ultraviolet lithography, the precision light technology required to print features at the 7-nanometer scale and below. Second, CHIPS Act funding essentially de-risks the massive capital expenditure required for the Ohio fab expansion. But here's what breaks the bull thesis: execution and gravity. Intel is trading at a forward P/E of 81.6x, a forward price-to-earnings ratio that measures how much investors pay for each dollar of projected profit. With an RSI of 88.4, the relative strength index that signals an asset is overbought above 70. This move is technically overextended. Any 3 nanometers process delay kills the momentum. We have to ask the question management avoids. Can Intel offset the revenue loss from China export controls with Habana Labs AI accelerators? The lab's answer is a hard no. While the US-China tech war restricts Xeon server chips to giants like Alibaba, the Habana pipeline isn't scaling fast enough to plug that hole. We are seeing a transition from surgical export controls to broad supply chain decoupling. This creates a valuation ceiling that the current 81.6x multiple simply ignores. Intel is technically redlining. With an AI score of 58 out of 100, we are not buyers at $124.92. Watch the $63.81 support level, the price where buying pressure historically stabilizes a decline. This rally lacks the fundamental yield to sustain these levels. Final verdict: avoid the FOMO. AMD is a buy with a lab score of 71 out of 100. The stock is currently riding a massive 26% surge in relative trading volume, signaling that institutional players are aggressively front-running that. AMD's 11.44% surge is a validation of its 80% yield efficiency advantage over Intel's monolithic designs, a manufacturing approach where the entire processor is carved from a single piece of silicon. While Wall Street fixates on Intel's Apple deal, the lab is tracking AMD's transition to TSMC's N3E, the enhanced 3-nanometer process node that increases transistor density by 18% over the previous generation. By utilizing a chiplet architecture, modular silicon dies interconnected on a single package, AMD avoids the reticle limit, which is the maximum physical area a lithography machine can print on a wafer. This allows AMD to achieve a 15% higher gross margin on its EPYC server chips compared to Intel's Xeon, because smaller dies naturally suffer fewer killer defects during the fabrication process. The quarterly financials showing modest revenue momentum for AMD. AMD's 91.2% EPS growth. Earnings per share, the portion of profit allocated to each outstanding share, faces a hard valuation ceiling as the Fed's 3.64% floor meets a new era of inflationary trade protectionism. While the stock surged 11.4% today, it is colliding with a macro environment where the Fed is quickly running out of reasons to cut rates. With CPI, Consumer Price Index, the measure of weighted average prices for consumer goods, at a cool 0.6%, and unemployment holding at 4.3%. The focus has pivoted sharply back to inflation. Prediction markets now price. AMD reported earnings per share of $1.37, beating the Wall Street estimate of $1.31 by 4.9%. A solid beat that signals strong execution. AMD is trending higher, currently at $455.19. Segment 3. The PR Insider Filter. AMD, the official story from AMD's corner office, is a masterclass in controlled optimism. Management is leaning hard on AI-driven demand and supply chain resilience, framing the company as the agile alternative to Intel's foundry struggles. They'll point to design wins in data center CPUs and GPUs, whisper about expanding TAM, total addressable market, the maximum revenue opportunity if every customer bought their product, and drop hints about next-gen Instinct accelerators. The message? AMD is the scrappy underdog poised to steal share in a $400 billion semiconductor market. Wall Street laps it up, 45 by ratings, a 23% R&D budget, and a stock that's held its ground despite Intel's Apple-sized headlines. But let's talk about the 327,948 shares insiders net sold in the last 90 days. That's not a trickle, that's a fire hose. When executives dump stock at this scale, they're not signaling confidence, they're signaling exit velocity. Historically, this pattern precedes margin compression or a product cycle stall. And it's not just insiders. Top 5 institutional holders are trimming positions too. If AMD's AI narrative were as bulletproof as the PR suggests, why are the people who know the roadmap heading for the door? EPS beat by 4.9%? Sure, but dig deeper. That R&D spend, $8.1 billion, up 25% YOY, is growing faster than revenue. That's not efficiency, that's desperation. Management calls it investing for the future, but the lab hears we're burning cash to keep up with NVIDIA's Blackwell and Intel's 18A. And then there's the earnings. The momentum breakdown for AMD. RSI sits at 80, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. AMD is riding a massive volume surge, 26.7% above its 20-day average. This signals institutional conviction in the Zen 5 CPU architecture, the high-performance core design launching soon. The Instinct MI200 accelerator uses HBM, high-bandwidth memory that stacks drum vertically for faster throughput. This Denver stock lab rates NVIDIA a strong buy with a score of 75 out of 100. While critics focus on valuation, they ignore the staggering 800% gross margin on H100 units. NVIDIA's trajectory toward a $10 trillion valuation is cemented by the Blackwell B200 architecture, which utilizes a dual-die design to bypass the reticle limit, the maximum physical area a lithography machine can etch on a silicon wafer. While the AMD MI300X offers impressive raw capacity, NVIDIA's 10 terabytes per second NVLink interconnect, the high-speed bridge connecting the two processor halves, maintains cache coherency with near-zero latency. Cache coherency, the process of ensuring all processor cores see the most recent version of data, is what allows these two massive dies to function as a single 208 billion transistor unit. By utilizing TSMC's CoWoS, chip-on-wafer-on-substrate with local silicon interconnects, NVIDIA achieves a 2.5D packaging density that competitors currently cannot yield at scale. The hardware moat is widening because of the 1.8 terabytes per second HBM3E high-bandwidth memory that provides the massive data pipeline required for generative AI. With a 2026 to 2001 revenue of $215.94 billion, NVIDIA is successfully monetizing the transition to the 4nm N4P process node, the specific manufacturing generation that balances transistor density with thermal efficiency. The thermal design power, or TDP, the maximum amount of heat a cooling system must dissipate, now sits at 700W to 1200W, creating a physical barrier that forces data centers to upgrade power infrastructure. Today's 1.75% move to $215.20 reflects the market pricing in this structural shift from general-purpose CPUs to accelerated silicon. The engineering reality is that as long as HBM3E yields remain stable, NVIDIA's margins are protected by physical scarcity. Quarterly financials showing modest revenue momentum for NVIDIA. NVIDIA faces a valuation ceiling as the 4.41% 10-year yield and tariff-induced inflation risks offset its 73.2% revenue growth. While the yield curve is normalizing, the return to a standard relationship where long-term debt pays more than short-term debt, the Federal Reserve is running out of reasons to cut rates. With unemployment at 4.3% and only 115,000 jobs added in April, the labor market is stabilizing, not collapsing. This allows the Fed to pivot toward inflation as trade war rhetoric over Greenland reignites. Aggressive tariffs act as a shadow tax on the global supply chain, threatening to spike CPI, the Consumer Price Index, which measures the average change in prices paid by consumers for goods. For a company growing EPS at 95.6%, these macro-inflationary pressures create a higher-for-longer interest rate environment that compresses the multiples investors are willing to pay for future earnings. The shift from surgical export controls, government restrictions that limit the sale of sensitive technologies to specific foreign countries for national security, to broad supply chain decoupling marks a new era of friction. We are moving toward Group D, 5 shifts, which designate countries subject to the most stringent arms and technology embargoes. This geopolitical pivot turns NVIDIA's global reach into a liability as trade protectionism fragments the market. Prediction markets now price the chance of an August Fed cut at a measly 6%, while recession risk sits at 7.3%. This cooling labor data combined with aggressive trade policy creates a pincer move on AI infrastructure. While the lab sees the underlying compute demand as a hero fighting economic friction, the macro environment has become a predatory force. The $10 trillion dream hits the physical wall of 4.41% yields and trade-induced cost spikes. NVIDIA reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%. A solid beat that signals strong execution. NVIDIA is trending higher, currently at $215.20. Segment 3. The PR Insider Filter. NVIDIA Corporation. The official narrative is a $10 trillion dream. AI demand is infinite. Partnerships are flourishing, and NVIDIA is the undisputed king of the data center. Management's script is polished. Enterprise AI control planes, long-term growth, and supply chain resilience. But let's flip the table. Insiders, executives, and board members have net sold 911,732 shares in the last 90 days. That's not a trickle, that's a fire hose. When insiders sell this aggressively, it's not about cashing out for a yacht. It's a signal they see a valuation ceiling or a looming headwind the market isn't pricing yet. The EPS beat, $1.62 versus $1.56, looks like a win, but dig deeper. R&D spend surged 43.2% year-over-year, outpacing revenue growth. That's not efficiency, that's desperation. NVIDIA is burning cash to stay ahead, and the math only works if AI demand keeps doubling forever. Meanwhile, the 8K language is telling, regardless of any general incorporation language in such filing. That's legalese for we're covering our asses, likely because auditors are flagging concentration risk in hyperscalers or export control exposure. What management is saying, we're leading the AI revolution. What the lab hears, we're one trade war or demand slowdown away from a margin reset. The PR is glossy. The signals are not. The momentum breakdown for NVIDIA. RSI sits at 60, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above 0. NVIDIA dominates through the H100 high-performance AI accelerator. They utilize EUV, extreme ultraviolet lithography, a precise light-based etching process. This hardware moats their 19.1x forward P/E, price-to-earnings ratio based on projected. Accumulate NVIDIA, MU, and AMD while avoiding Intel as high-bandwidth dominant scales. Not financial advice. Do your own research. Timber Stock Lab.